Studies show that nearly two-thirds of Americans worry they'll never save enough to retire. But here's something most people don't realize. Investors who consistently reinvest dividends through ETFs are more than 40% more likely to achieve financial independence early. Imagine your portfolio working for you day after day, paying you like a second salary, even while you sleep. That's the true power of dividend ETFs. But here's the challenge. Most investors chasing early retirement make critical mistakes. They pile into risky growth stocks that may soar in the short term but don't pay any income, or they play it too safe with savings accounts and bonds that barely keep up with inflation. Then you add market volatility, the risk of dividend cuts, and poor diversification, and suddenly even the most well-intentioned retirement plans can crumble. Many people also underestimate just how important reinvesting dividends really is. It's not just about collecting a payout today, it's about letting those dividends compound over years, even decades, multiplying your wealth in ways that a simple savings plan never could. Without the right balance of growth, stability, and cash flow, even a six-figure portfolio can fall short of covering basic living expenses in retirement. That's why you need a structured strategy that blends reliable income with long-term compounding power. And this is where dividend ETFs shine. Instead of gambling on individual dividend stocks where one company cutting its payout could devastate your income stream dividend, ETFs spread your investment across dozens or even hundreds of income-producing companies. This diversification reduces your risk, provides more consistent payouts, and lowers the stress of managing a portfolio on your own. Think of it as building a machine that's designed to keep paying you year after year, regardless of short-term market noise. If you enjoy this kind of content, don't forget to like, share, and subscribe. It helps me reach more investors like you who are serious about building financial freedom. And just a quick reminder, this video is for educational purposes only. It's not financial advice. Dividend ETFs are powerful, but they do come with risks, so always do your own research before making any decision. All right, with that out of the way, let's get into the heart of today's video. The ultimate ETF strategy I'm going to share with you has three layers. High yield for cash flow, ETFs that pay weekly or monthly, giving you frequent income you can use or reinvest. Dividend growth for inflation protection, funds that focus on companies raising dividends year after year, helping your income grow steadily over time. Core stability for long-term compounding, broad market ETFs that provide steady growth and resilience across economic cycles. Together, these three layers can give you the foundation for an early retirement strategy that doesn't just aim for survival, but for financial freedom. The first ETF on my list is QQQI, the NASDAQ 100 Covered Call ETF. Now this one is all about high yield for cash flow, which is the first layer of our retirement strategy. QQQI uses a covered call strategy on some of the biggest names in tech. Think Microsoft, Apple, Nvidia, and Amazon. By selling options on these companies, the fund collects option premiums and passes that income directly to shareholders. The result? Double-digit yields that are paid out monthly, and in some cases, weekly distributions depending on the setup. That means instead of waiting every quarter for a payout, you're getting consistent, almost paycheck-like income from some of the strongest companies on Wall Street. The expense ratio is higher than a plain vanilla ETF, around 0.68%, and distribution rate 14.42%. But for income-focused investors, the cash flow often outweighs the cost. What makes QQQI especially valuable for anyone chasing early retirement is how it smooths out market volatility. Tech stocks can be volatile, no doubt, but the option premiums collected act as a buffer, providing income even during sideways or choppy markets. This steady stream of cash can be reinvested to accelerate compounding, or later in life, used to fund living expenses without needing to sell off shares. In simple terms, QQQI helps turn a growth-heavy sector like tech into a cash flow machine, which is exactly the kind of tool that can bridge the gap between building wealth today and enjoying financial freedom tomorrow. For investors who want exposure to the innovation of the NASDAQ but also need consistent income to support an early retirement plan, QQQI delivers on both fronts. The second ETF I want to highlight is SPII, the NEOS and P500 High Income ETF. While QQQI focuses on tech-heavy NASDAQ names, SPII takes a broader approach, using a covered call strategy on the entire S&P 500. That means you're tapping into America's 500 largest companies from Apple and Microsoft to Johnson & Johnson and ExxonMobil, while collecting option premiums that are paid out as dividends. SPYI's dividend yield sits in the double digits, with monthly payouts that can feel like a steady income stream for investors. Its expense ratio is about 0.68%, which is higher than a plain S&P 500 index fund like VOO, but you're paying for the added income layer that comes from its option strategy. Over the past year, SPYI has proven itself as one of the most popular high-income ETFs, and for good reason. Here's why SPYI is a retirement game-changer. The S&P 500 is already one of the most reliable wealth-building engines in history. Pair that with consistent monthly income, and you get both growth and cash flow. For early retirement seekers, this means you don't have to rely solely on selling shares when the market is down. The income keeps coming in regardless of short-term price swings. In essence, SPYI gives you the best of both worlds: exposure to the stability and growth of America's largest companies, plus an enhanced yield that provides the kind of consistent cash flow needed to support an early retirement lifestyle. For investors who want diversification across the whole U.S. market while still collecting high-frequent dividends, SPYI deserves a spot on the list. The third ETF on this list is JEPI, the JP Morgan Equity Premium Income ETF. Now, JPI has quickly become one of the most popular income ETFs on the market, and for good reason. It uses a covered call strategy similar to SPYI, but instead of focusing only on the S&P 500 index itself, it combines blue-chip U.S. stocks with equity-linked notes, ELNs, to generate consistent premium income. Currently, JPI offers a dividend yield around 8 to 10%, with monthly distributions that provide investors with reliable cash flow. Its expense ratio is relatively modest at 0.35%, especially considering it's actively managed by JP Morgan's team, which is one of the biggest selling points. You're not just buying an ETF, you're buying into professional oversight. What makes JPI especially attractive for early retirement planning is its balance. Unlike some high-yield ETFs that lean heavily into leverage or take extreme risk, JPI is designed to reduce volatility while still delivering strong income. That means it's less likely to experience the same wild swings as pure growth funds, giving retirees or aspiring early retirees more peace of mind. For investors, JEPI can serve as the steady income engine of a portfolio, the kind of fund that consistently pays the bills, while your growth-focused ETFs continue compounding in the background. And when paired with funds like QQQI and SPYI, JPI adds an extra layer of risk management and stability without sacrificing much on yield. In short, JEPI is the type of ETF that can help investors retire early and stay retired by delivering a dependable income stream, keeping volatility in check, and leveraging the strength of JP Morgan's active management. The fourth ETF on my list is QDVO, the Global XS and P 500 Quality Dividend ETF. QDVO is all about quality and dividend growth. It screens companies in the S&P 500 based on financial strength, earnings stability, and a track record of paying and growing dividends over time. Currently, QDVO has a dividend yield in the 3 to 4% range, with quarterly payouts that may not look flashy compared to double-digit yielders, but the secret weapon here is growth and compounding. Over the past several years, QDVO has delivered strong total returns by holding companies like Microsoft, Johnson & Johnson, and Procter & Gamble, names that not only survive downturns, but often come out stronger. Its expense ratio is just 0.20%, making it relatively cost-efficient for investors who want quality exposure without overpaying in fees. Here's why QDVO is critical for an early retirement strategy. High-yield ETFs can provide great cash flow today, but without dividend growth, your income risks being eaten away by inflation. QDVO solves that problem by investing in companies that raise their dividends year after year, helping ensure that the income stream you rely on in retirement doesn't just stay flat, it grows with you. In other words, QDVO isn't the paycheck today. It's the raise you'll get tomorrow. Combine it with the income machines like JPI, SPYI, and QQQI, and you've built a portfolio that pays you now while still compounding for the future. That's the ultimate balance for anyone aiming to retire early and stay retired.